You're welcome again to another financial reporting class. Today, we are going to be looking at a fresh topic, which is IAS 12 on income taxes. Remember that yesterday we concluded IAS 36 on impairment of assets, and we solved quite a number of questions. Today, we'll be commenting IAS 12 on income tax. So basically, when we say taxes, see, or let me say it refers to a compulsory levy paid by residents of a country. But that definition is not completely correct or accurate if you want to go deeper into the tax laws, because non-resident entities are also required to pay tax in a country where they do business. But let's just leave it for now like this, because that's not the focus of this class. And examples of taxes that are popular are, you have taxes like company income tax, you have taxes like value added tax, you have taxes like withholding tax, you have the personal income tax, and the list go on and on. There is even capital gains tax. So the objective of this class is basically, how do you recognize and how do you measure these taxes? And obviously, personal income tax, at least from the perspective of the entity, which is the tax that the company pays from staff salaries, that's not our focus here in IAS 12. Even value-added tax is not our focus here, or even withholding taxes. Our focus in IAS 12 is accounting for company income tax. That's our core focus, and that's the direction of this standard. When we are talking about taxes, there are certain terms we need to identify. And the very first of that terminology is taxable profits. Because without a taxable profit, we cannot pay company income tax. So taxable profit is a profit that is determined using the extant tax laws or the rules of the taxing authority. So This IAS 12 assumes that you know how to determine taxable profits in your country. So for those of you that are offering taxation at this level, good for you, because it will help you in this topic, because you will really need to be able to determine taxable profit. This is a profit that is determined using the extant tax laws or the rules of the taxing authority. Also, we have accounting profits. This is the profits before deducting income tax. Let me say income tax expense. This is also known as we call it profits before tax. We can call it PBT. So we are asking for another meaning for extant tax laws. It means the current tax law in the country, the current tax law in that country. So that's how we just refer to it as extant. The tax, if you are not comfortable with the extant, you can just use just tax laws. Or you can, that's why I use another word, the rules of the taxing authority. So accounting profits for IAS 12 is like PBT, is the profit before deducting income tax. That's accounting profit. And what's then income tax? This is the aggregation or the combination of current tax and deferred tax. Income tax is the aggregation or the combination of current tax and deferred tax. From there, I can pick two terms. We have current tax. This is the tax that is paid or payable in respect in the current period in respect of the taxable profit. That's current tax. Is the tax that is paid or payable in the current period in respect of the taxable profit. Why deferred tax? This is the tax that is payable or recoverable in the future period in respect of temporary difference. Okay, so these terminologies, I will still come back to each of them along our 2 hours class that we have today. We have taxable profits. They are profit determined using the tax laws. We have accounting profit, is the profit before you deduct your tax. And get used to income tax. Income tax is the addition of current and deferred tax. While current tax is the tax you pay in respect of in the current period. Deferred tax is the one you would pay in future period in respect of temporary difference. So I don't want to go into temporary difference now. I will go into it very soon. So I guess we should get to it because now I can't jump into teaching you taxable profits, right? I can't start teaching you how to determine accounting profit because they will give you most often than not, but you will see questions that will require you to calculate taxable profits. So I will use that to show you how the taxman determines its own profit using the tax laws. Also, I think then makes sense for us to start with current tax. So basically what I want to teach you today is current tax and deferred tax. So let me start with current tax. So you already know from this definition that this current tax is the tax that is paid or payable in the current period in respect of taxable profit. So when you want to determine your current tax, usually there are usually laws on how to determine it. In each country, like in Nigeria, we have the current tax rate, which is at the moment is 30%. And there are also other taxes aside that income tax or current tax. There is the police trust levy. There is the Naseni. There is the NITSDA. All of these, they are all current tax. You pay all of them on your taxable profit. All of these make up your taxable profit. So they are determined based on the tax rates. That's how they are actually determined. So in the exam, they will give you that rate that is actually workable or present in that country at that point in time. So when you determine that, then you then have your tax. Now, if the current tax is determined, for example, as let's say 10,000 for 2022, the way it is recognized is just to, let me say you'd put it as part of your income tax in your profit or loss as a deduction from your profits. And you would usually credit a current tax payable. So the way it works is that this tax for 2022, you usually don't pay it in 2022. You will not pay it in 2022 because in Nigeria, taxes for 2022 financial year is required to be paid in 2023 because we usually use a preceding basis approach. In fact, the laws allows you that you would have 6 months after your year end for you to file your returns, then pay your tax. But you know that we cannot wait for that period before we prepare our account. So we would usually have determined the estimate of tax, which is this 10,000, and you would have passed it in your account as this P&L, then you will put it as a liability, as that, then you submit, then your account goes like that. Now, in 2023, the government will come to you after you have filed your returns. The government would usually come for desk review. You see, as soon as you file your accounts, they'll come for desk review. And the result of that desk review is that you would eventually agree on what the actual tax would be. So if the actual tax is agreed at 15,000, if the actual tax is agreed at 15,000, it means that you would be required to pay 15,000. And they will tell you it's 15,000 you should pay. Therefore, how do you then net this off from your book? Let's assume you have not paid this 10,000, just for simplicity. So they agree that it's 15,000 you should pay. It means that, let's assume you are now paying this 15,000. You can only debit your current tax payable with how much? With 10,000. Because from your books, from your own estimates, you thought you were owing 10,000. So you will net off 10,000 against this current tax payable. So there is a balance of 5,000. Where would this 5,000 go? There is a balance of 5,000. Where will it go? Just simply debit income tax in your P&L with that 5,000. So the interpretation is this. In 2022, the tax you were actually supposed to pay was 10,000, but based on your own workings, you thought it should be, I said 10,000, it should be 15,000, but based on your own working, you calculated 10. Fine, so you'd entered your books as this. So, but when it came for tax desk review, I mean FIRS, then it is actually agreed that no, it should not be 10, but rather it should be 15. So let's say you then agreed 15, you will net off the 10 you have provided for. Then the additional 5,000 is what you should have done is an additional tax for you. But the reality is this, the way it's done in real life is that because at the point where you are paying it is not the end of 2023. So you won't really have prepared like a P&L account, because P&L account will be done, let's say, at the end of the year. So this account is a debit account that we usually describe as under provision for tax or underestimation for tax, which means that this 5,000 is there because we underprovided for tax in the previous period. We underprovided, so there will be a debit balance. So we would describe the account as tax. So it can be described simply as current tax also, but it will be there as a debit balance, maybe in your trial balance. It will be sitting there. That balance is there as a debit. But you should understand that whenever you see a debit balance in a tax account, in a current tax account, is because we underprovided last year. So when we are preparing our accounts, we'll just make it up. Because ordinarily, this 5,000 should have gone to P&L since last year. But because we didn't know, it's tax. You will never know until you agree with the tax authority eventually. So we then agreed that, okay, we need to top up with additional 5,000. Then the additional 5,000, we will then put it that, okay, we'll open an account as under provision, 5,000, then which eventually goes into your P&L. That means that it could be the reverse as well, where this is like option 1. It could be an option 2, like a scenario 2, where the tax that was agreed after the desk review is, let's say, 8,000. 8,000. So without even me telling you, for my explanation up here, you should understand that it means that we had overprovided. Because with this 8,000, that means what we will pay is actually we'll actually pay 8,000. And in our current tax payable, what we have there was 10,000, but we can only net it off with 8,000. The remaining balance on that account, we need to also take it to an over provision for tax account. It becomes we had over provided. It's not even it should be like a credit. Over provision for tax of how much? Of 2,000. So to cancel out this current tax payable account, so let's take it out. With a debit of 10,000, but we had over provided in the previous year by 2,000. Now, all of these debit and credit I'm showing you is just to prepare you for the bigger picture. Look at the way you will most likely find it. in a question. Again, this over-provision account also, when you are preparing your P&L at the end of the period, it also goes to P&L at the end of the period. But in this case now, you will see that it's having a credit, which means that since in 2022, we entered 10,000 instead of 8,000. So we over-provided last year. So we are compensating for that this year by using netting whatever tax we are putting in our books this year. We are going to net it off by 2,000. We're going to reduce it by 2,000. So unfortunately, not really unfortunately, that's how tax works in Nigeria. So that at the end of the current year, we can only make an estimate for tax. It's only after we have filed returns that we can only then know the actual amount of tax we would pay. So you would always find this kind of situation. Either you are over-providing, that you have over-provided, or under-provided. So, and you would really see that as a balance. So whenever you see a trial balance anywhere, and you see current tax on the debit, for example, that there's a debit balance, you just know that that's an under provision. It is. You can quote me anywhere, anytime. It is. That is what it is. Because the tax for the year itself, you will not find it in the trial balance. It's not there. You will never find it because it's always determined at the end of the year after you have determined your profit. So it goes straight into your P&L, or they use a journal to enter it eventually. So when you then find tax in the trial balance and they describe it as current tax, it's not the tax for that year. It's an over or under provision. So if it's having a debit, just know that the law is requiring that you should pay more, and that debit balance is the addition you have to pay. That means you had under provided last year, and you have been asked to pay that you have paid. So you should know that it's going to your P&L as an additional expense for you. That's why it's a debit. It comes in as an additional expense for you, additional tax, something like that. And if you are seeing it as a credit, it means that you have over provided last year. Your tax of the previous period was too much. It was too much that this year now you then discover that you had over provided by 2,000 last year. So this one will just help you reduce your current tax for this year to P&L. So when I'm teaching you, or when we are solving questions on published account, then you would see how these are adjusted for in the financial statements like that. Now, is Femi around? Can you read this question for us?
Yes, sir. Good evening, sir.
Hi, Femi. How are you today?
Fine, sir.
Please read this question.
In 2017, Lawal Limited had taxable profit of 60,000 naira. In the previous year, 2016, income tax on 2016 profits had been estimated as 15,000 naira. The corporate income tax rate is 30%. You are required to calculate current tax payable and the charge for 2017. If the tax due on 2016 profit was subsequently agreed with the tax authority as A, 17,500, B, 12,500. Any under or over payment are not settled until the following year tax payment is due.
Okay. So you will see that in 2017, this company has a taxable profit. So be very watchful. This question has given you taxable profit. If they tell you accounting profit, that means you will need to determine taxable profit. So they gave us taxable profit of 60,000. And last year, our income tax on our 2016 profits, we estimated 15,000. And the corporate tax rate in that country is 30%. Now, they want us to calculate current tax for 2017. If the tax due on 2016 is now subsequently agreed with the tax authority as A, 17,500, B, 16,500. So solution A. So if the tax is agreed as 17,500. So how do we deal with this? So the current tax for 2017 would be, first, the estimate of tax for 2017, the estimate of current tax for 2017 is 30% times the taxable profits of 2017. How much is that?
18,000.
18,000. However, the estimate of tax in 2016 was 15,000. But now, the actual tax that is now agreed in scenario A is 17,500, which means that this guy had done an under provision for tax last year of 2,500 because he estimated 15,000, which means that last year he will have recognized 15,000 as tax in his P&L last year. But now we are now agreeing that it is not 15,000 you should have recognized, it's actually 17,000. So he has underprovided by 2,500. So it is this year that will suffer it. So that means this year, our current tax that will go to P&L is now 20,500. So ordinarily our tax for this year should be 18,000. What we owe this year is 18,000 because that's 30% of our profit. And the two legs for this is one leg goes to P&L, the other leg goes to current tax payable. However, like I've explained earlier, the impact of last year is now coming this year now. This guy provided for 15,000, but now we find out that what he should pay is 17,500. So he had underprovided by 2,500. So we suffer it. Additional expense for us. Okay? Even though he would have settled it, it's not like he's paying this one, he will have paid it. Okay? In such a way that our liability for this year is actually 18,000. You need to understand the difference between this 18,000 and this 20,500. Our liability for this year is 18,000, no doubt. This 25 is just saying that you now have an additional expense. He has settled this, he has agreed, he has settled it. This 17.5. He has settled. So this one is not coming in as an extra liability, but it's saying based on accrual convention, you have an additional expense that you're supposed to have recognized last year, which you did not. Now, on the flip side, it says that, which is the B, that if the tax is agreed as 12,500, which is the B part here. So again, the estimate of current tax that will, for this year, ordinarily, for 2017, should simply be 30% of our taxable profits of 60,000, which is 18,000. However, our estimate in 2016, we estimated 15,000, but the actual tax after the desk review is now 12,500. Now, this shows that this guy had over-provided for tax. He had over-provided. So instead of him to recognize 15 in his P&L last year, in fact, instead of him to recognize 12,500 in his P&L last year, he actually recognized 15,000. So he had overstated his expense. Let me put it that way. So this year we need to correct that. We need to reverse that by removing that. So our current tax expense that goes to our POL is now
15,500.
15,500. You need to seriously understand this. Current taxes is no more than this for your exam. The only additional thing you would find is if the examiner wants you to calculate taxable profits in such a way that the examiner will not give you taxable profit and they will want you to calculate it, which we would see a past question that can help us with that, where you will have accounting profits for the taxman will say add back depreciation, and it will say, okay, I'm giving you capital allowance. You deduct capital allowance, then you get a taxable profit. And they will give you some other details, like some other deductible expenses and some expenses, some income that are non-taxable or exempt, and all of that. They could give you those details, but it will be very subtle in your exam. So we would see few questions like that we can practice. But beyond that, this is how you adjust for your current tax that goes to P&L. And again, don't forget that your liability, your tax for 2017 is actually 18,000. In such a way that what you will find in your statement of financial position as your tax payable would be 18,000. But as a result of the over provision you did last year, which you have to then impact this year, that is why what goes to P&L will be 15,500. That's what you find in your profit or loss account. Okay, so that is the calculation around current taxes. Now let me take questions before I finalize current tax with presentation of current tax. Okay, do you have any questions, please? Elozo?
Yes, I do.
Okay,
Thank
please
you,
go
sir.
ahead.
All right.
Yeah.
The workings, it's quite clear. My challenge here is the journal entry, the posting. Like you said, our current tax is 18 that will go to statement of financial position, and the P&L, what we go is this 15,500. I don't know if you can just restate what you just said.
Okay, I didn't quite get your question very well, but what you have said is actually correct in the sense that, like in this scenario A, what goes to our our what we owe for this year is 18,000. That firstly, you debit POL with this, and you credit your current tax liability with this amount. This is what we owe. But as a result of this adjustment against last year, because this one also, you will still be owing it, this 15,000, or you might have even paid it, this 15,000. But they then came and say, no, you need to pay an extra 17,500, which you have also paid, right? So there will be this 2,005 as a leftover from this account, from this 2016 account. Okay, so you would expense it. You just expense it, this 2,005. But what we owe is this 18,000 P&L liability. Okay, this one you have already passed your entry. It's just like it might be your liability from last year, whether you have settled it, whether you have not settled it. But eventually, we are saying that what we should pay is 17,500 for last year, right? So by the time you net off this 15,000 from this 17,500, there's an extra debit. There will be an extra amount that is required, which you might have paid, but by the time, let's say you actually paid, you credit bank, okay, with this extra 2,500, there is a debit that we call under provision for tax. This under provision for tax, you will need to then expense it to your income tax, to your current tax. That's why this is coming to 20,005 this year. And the same thing applies to this. What you owe is 18,000. It's like you're debiting P&L, your current tax, and crediting liability. Now, this one is relating to last year, is your tax of last year. But now they came and say, nah, no, it should be 12,500. So that means you're having a credit of 2,500. You're having a credit of 2,500 that you need to net off by probably you debit that account and you need to credit an over provision account, okay, with 2,005. Now, this over provision account would also go to P&L, but since your income tax is a debit account, so it reduces it by 2,500. Okay, so I understand very well that there are some of you here, maybe not everybody, there are some of you that are very good with double entry, debit and credit. Some are not very good with it. So, which is why when I'm actually solving this question, I'm not doing a lot of debit and credit here and there. But in my explanation, you will see that I was intentionally doing it. Because I know that for your exams, you are mostly not required to be doing debit and credit everywhere. So this schedule is just fine for you. What we are interested in is what I've told you. Know what goes to P&L. Is this 25 that goes to P&L? Note what goes to statement of financial position as what we are owing in both scenarios. Okay, if you know that one, you will pass your exam seamlessly. However, knowing this debit credit thing makes you a better accountant to a large extent. I mean, it makes you have this background knowledge like that. I've said a lot. I don't know if along saying all this much, I've answered your question, Eluzo.
Yeah, thank you. Thank you, sir.
Okay.
So
Yeah.
there's possibility they don't ask us to prepare double entry for this for income tax during exam, like for exam purpose.
They have never asked you to do that. They have never asked you to do that. So they won't ask you to do that. So this is what you should know. But I think you should also understand all this double entry process, the way it works in the back end is important. But this is what you'll be required to do in the exam. These I've shown you. So from what I've shown you, you will see that the current tax is usually presented in the profit or loss statements, except taxes arising from business combination. Okay, so when I mean taxes arising from business combination, so if a parent acquires a subsidiary and whatever balance of tax that the subsidiary has, it will be part of the acquisition. So they will treat it as just tax assets or tax liabilities. And it's treated as part of net asset acquired that will be cancelled out on consolidation. So any taxes arising from business combination, we don't expense that because they are usually treated in the calculation of goodwill. You would understand that better later, that you will see that the parent will just treat it as part of what he is acquiring, as part of what he is buying. There is no separate treatment for it. There's no separate, so you will just treat it as part of what we are buying in that subsidiary. Also, transactions or events that are treated in other comprehensive income, or directly to equity. So any transaction that is treated in OCI or directly to equity, any taxes on them, you don't take them to P&L. You take them to equity or OCI. An example is revaluation surplus. Any tax on that, you take it to OCI. Or when I teach you IAS 8, and we are talking about retrospective application of, or to put it simple, when we are correcting a prior period error, that we have to correct it through retained earnings. So whatever tax impact of that would also be treated in retained earnings. And I believe that should be logical. Since those items did not go to P&L, it means the taxes on them should not also go to P&L. So any item that is in OCI the taxes on them should be treated in OCI. Any taxes in equity, any item in equity, the taxes on them should go to equity, in as much as they are taxable items to a large extent. So these are the two items that you will not find in your POL. Okay. That is it for current taxes. The next one is deferred tax. Like I explained when I was giving you these definitions, I came up with this definition myself because IAS 12 didn't specifically give us a direct definition for tax, but I just coined this one. I coined a definition that will look a little simple for you. I said, this is a tax or the tax that is payable or recoverable in the future period in respect of temporary difference. So that means deferred tax is either payable or recoverable. So the one that is payable, we call that deferred tax liabilities. And that is therefore the tax that is payable in the future period in respect of, we call that in respect of what we call a taxable temporary difference. I'll come to that very soon. The deferred tax that is recoverable, we call that deferred tax assets. And this is the tax that is recoverable in the future period in respect of one, deductible temporary difference. We have carry forward of unused tax losses and unused, and carry forward of unused tax credits. Okay, I'll come to these three in detail very soon. I'm still introducing some core points to you. So from all of this, even starting from here, I can see that deferred tax is looking at the taxes relating to future period. They are payable in future period or recoverable in future period. The one that are payable in future period, that makes it a liability. The ones that are recoverable in future period, that makes it a deferred tax asset. So even though we are going to pay it or recover it in the future, because it would have related to the current year transaction, so we have to put it in our books. But we all agree that even though it relates to this year transaction, we have to pay it for one reason or the other in the future. And that reason or the other is what is called temporary difference. Okay? Because I said is in respect of temporary difference. That means that if you then want to understand deferred tax very well, you need to understand temporary differences very well. When you understand temporary differences very well, then that means you would be fine. What is then temporary difference? So this is the difference between the amount in the books and the amount the tax authority captures for tax purposes. So the amount in the books is referred to as a carrying amount. The amount the tax authority captures for tax purposes is referred to as a tax base. Hence, we can say temporary difference is the difference between the carrying amount and the tax base. Okay, look at the way I moved. I firstly mentioned that temporary difference is the difference between the amounts in the books, or let me write it fully, the amount recognized in the books and the amount the tax authority captures for tax purposes in respect of the item. Let me put it that way. In respect of the item. So then I now broke it down that the amounts recognized in the books, in your book, is referred, we call it carrying amount for these purposes. And the amount the tax authority captures, we call it, for tax purposes, we call it a tax base. So this temporary difference is the difference between the carrying amount and the tax base. So I will give you examples of these items that can result in examples of items that can result in temporary difference. So then that will clarify everything. So there are a lot of examples which you would find where the amount that is in the books will be different from the amount the taxman would enter into his own books. Example is depreciation. So depreciation is the amount in the books, but what you will find that the tax authority will capture is capital allowance. So depreciation or capital allowance will result in temporary difference. Also, another one is, let me give you a practical one. Let's say provisions. When you make a provision in the books today, you would agree with me that the taxman will say no to it. What the taxman will capture for tax purposes will be zero. The taxman will capture zero. But it's not like the taxman will not capture it at all, but they will not capture it now until that provision is actually paid. Taxman will not allow provisions. They will only allow what expenses that is paid. You need to show us evidence. They want to see evidence of expenses that it is only incurred, necessarily incurred, reasonably incurred, and exclusively incurred. So when you tell them you are making a provision, they will say no, they won't allow it. So their own tax base will be zero. Though they will allow it in the future. They will allow it in the future. So, which is fine. Also, is any form of impairment loss. When they see impairment loss in your books, or maybe a revaluation deficit or a revaluation surplus, taxman will say no. No. Did you pay any expense? They will not put it in their own books today. They will say, yes, when you incur this expense, when you actually pay this expense. So if you then sell the assets and you now make a loss, then the taxman will say, okay, yes. Then they will put it in their books. So these are examples of temporary difference. It's very straightforward. It's just understanding that, okay, the taxman say you cannot put it now, but you will put it later. Okay? Now, so examples of items that looks like temporary difference, but they are not temporary difference. Example of items that are not temporary difference because they are a permanent difference. So you have to be very careful. They will set trap for you that they will tell you the taxman did not allow it this year, but it's in your books. If you go and capture that as temporary difference, you are wrong. Go like an example is which one now? Let's say grant received, for example. When you receive a grant, the tax in your books is fine. But for the tax authority, usually this grant is tax exempt. Meaning that it is never going to be included, it is never going to be captured in the books of the tax authority. That is a permanent difference, which means that there is no tax that will arise in future period, or there is no tax that will be recoverable in future period because it has no tax consequences. In fact, let me put it as any other item that has no tax consequences. Any item that has no tax consequences. So any item that has no tax consequence will be is a permanent difference. It is not a temporary difference. So let me now go back so that you will not forget where I'm coming from. Where I'm coming from is that deferred tax is a tax payable or recoverable in the future period in respect of temporary difference. And temporary difference is the difference between what you have in your books and what the taxman captures. So an example of those temporary difference are depreciation and capital allowance. You enter 10 naira. The taxman said it should be 15 naira. So you might think you are enjoying today, but it will net off tomorrow. Provisions. You entered, let's say 10 naira. The taxman says is zero. the taxman say, wait, even though we are not giving you this credit today, you will enjoy it tomorrow. Okay? So, I mean, that's the idea. You will enjoy it tomorrow, or you will pay tax on it tomorrow. Or maybe you have a revaluation surplus. For example, the taxman says that, you cannot pay tax on this year because you have not actually earned it. There is no money to show that this is an income. The taxman say, okay, fine, that you are going to pay tax tomorrow. That's what we call deferred tax. That's what we call deferred tax. So for simplicity for you, even though in reality, to be sincere with you, in reality, deferred tax, you don't actually pay or recover it. It's just an accounting device. I don't want to go there yet, but I mean, just understand the whole idea, the background for now, the way to know it very well, so that even beyond your exam, you'll be able to do it even in real life. So these are the popular items you find having temporary differences. Now, you see this temporary difference, which is what you enter in your books, which we call carrying amount, and what the tax authority enters in their book, which we call tax base. You see, it can either be a taxable temporary difference. If that temporary difference will make you pay tax in the future, that they are saying don't pay tax now, you are going to pay tax in the future, then of course that's a liability. We call that a deferred tax liability. And from the examples I've given you, the one that can result to that is this revaluation surplus. So they say that, you say you made a surplus. The taxman say, okay, calm down. Don't pay tax now. You will pay the tax in the future when you actually earn this money, right? So this type of temporary difference is a taxable temporary difference because you are going to pay the tax in the future. While the deductible temporary difference is the one that would allow you to have like a recoverable tax in the future that would help you reduce your tax in the future. That one give rise to a deferred tax asset. An example of that is when you want to claim a provisions that you are putting in your books now, right? When you're claiming a provision you are putting in your books now, but the taxman says, no, you cannot claim it now because there's no evidence that you have actually incurred or paid these expenses from the taxman perspective. They will say, okay, hold on, wait now. When you pay it, you will claim it. So that means that there is a temporary difference that will result in you claiming or reducing your tax in the future. That is a deductible temporary difference or an impairment loss that the taxman says that, yes, now you are putting it in your books as an expense. We cannot allow this to fly. You cannot claim this expense. We will not capture it. But when you actually incur it, when you actually show evidence that, yes, you have made this loss, then you can claim it in the future. You can use it to reduce your tax in the future. That is a deductible temporary difference. It gives rise to deferred tax assets. Now, for depreciation and capital allowance, the reality is that you have the figures in your books together. So for this one, if the carrying amount, it might apply to other ones too. It might apply, but it majorly applies to depreciation and capital allowance, to be sincere with you. So it can apply to other ones too, but is if the carrying amount is higher than the tax base. If the carrying amount is higher than the tax base, what type of temporary difference is this? Do you think it should be a taxable temporary difference or a deductible temporary difference? If the carrying amount is higher than the tax base, that is, for example, your depreciation, you put 50 naira. The taxman says, no, now, you cannot take up to 50 naira this year. You can only take 40 naira this year. Okay, you can only take 40 naira this year. So that means to a large extent, the taxman is giving you like a smaller expense this year. Is giving you like a smaller expense this year. So would that be, are you going to claim more in the future, or are you going to pay more tax in the future? If the carrying amount is higher than the tax base, which one is this? So this is a taxable temporary difference. If the carrying amount is higher than the tax base, but you find out that when you are determining carrying amount, you will still have to do cost minus the accumulated depreciation. When you are doing tax base, you still have to do cost minus the accumulated capital allowance, really, for this. And that means that if the carrying amount is then lower, then you would have a deductible temporary difference. So that's really applicable only for capital allowance to depreciation, because is difference in amounts. Why the taxman is saying, okay, you can only put 14 naira, while the tax authority, while you in your books you had 17 naira, they said, okay, for now you can still only put 40. You can only capture 40 for now. Then later, you would capture the remaining. So we will say that this one will result in a taxable temporary difference, while much later, if it's the reverse, you would have a deductible temporary difference. Okay, that's the background knowledge for deferred tax, and basically that is the most of what you are going to find in your exam. We'll start solving questions now. That's what is remaining for the next 40 minutes that we have. But I need to mention this carried forward of unused tax losses or carried forward of unused tax credits. So when you have tax losses, right, the law as it is right now requires that you can use it against your taxable profits in the future. So tax losses will result in recoverability of tax in the future period. So that's why it's an asset. It will help you reduce your tax in the future. Also, when you have withholding tax credits, if you have unused tax credits, like unused capital allowance, for example, that you need to carry forward, it will help you reduce your tax in the future. That is why this is coming up underneath these guys. Okay, I think I've said a whole lot. Can you guys say something also? Anybody? Any questions, any contributions, anything at all? Anybody? Femi, say something.
Can you hear me, sir?
Yes, I can hear you, Uche.
In a question now, how do we then determine the deferred tax liability and deferred tax asset?
That's the easiest. Just apply 30% on that temporary difference. That one is the easiest. So as soon as you get that difference, that temporary difference, just apply 30%. If it's a taxable temporary difference and you apply 30% on it, you get your deferred tax liability. If it's a deductible temporary difference, you slam 30% on it, you get your deferred tax assets. So that one is the easiest part of it.
So
Sir,
when the
Please come
carrying
again.
amount,
Okay, Uche, hold on. Let me just come again. So I said that when you get your temporary difference, if it's a taxable temporary difference, just apply 30% on it. Whatever you get is the deferred tax liability. If it's a deductible temporary difference, slam 30% on it. Whatever you get is a deferred tax asset. The same thing applies for carry forward of unused tax losses and carry forward of unused tax credit. Apply 30% on them, you get your deferred tax asset. So you will see them in
so
action very soon.
sorry, sir.
so for us to
Let's,
get
okay.
tax difference now is when the carrying amount is higher than the tax rate, right?
Yes.
Then the reverse for a deductible temporary difference when the tax rate is higher than the carrying amount.
Yes. Yes. So, and that one majorly for capital allowance and depreciation. You see, things like provisions, that one is always clear because the taxman will not even enter anything at all. He doesn't want to allow it. You cannot deduct anything. So that one, you know that you are going to be deducting it in the future. Okay, so that one is easily interpreted as deductible temporary difference.
Sorry,
Deductible temporary difference.
hello, sir.
Yes, Damilola.
From the examples of items that can result in temporary difference, we this depreciation on capital allowance. So we know depreciation is disallowable expenses, like is not allowed. Because of capital allowance that might have been charged on the asset. You now putting depreciation on a slash capital allowance. Is it that the capital allowance is still replacing the depreciation, or is still possible for charges to still come on depreciation? I don't know if you understand my question, sir.
Yes, it's like is as you have said it, the capital allowance is simply replacing the
Depreciation.
depreciation. Yes.
Okay.
So yeah, but our own concern as accountants here is that um we need to book. There's a temporary difference happening now because what is in our book was, let's say, 10 naira, and the capital allowance this guy is giving us is 8 naira. We need to book a temporary difference. So we need to account for a temporary difference. That's what I'm teaching you today. And when you account for that temporary difference, there is a deferred tax there that you need to book for. So beyond, you find out that eventually this one is very easy to calculate. But again, there are other ones. It's not just the depreciation and capital allowance that result in temporary differences. It's really the fact that there are some expenses or income that what the taxman will capture will be different from what you are capturing, like provisions. The taxman would not even capture anything at all because they will say it's disallowable. Okay. But not that it's totally disallowable, but it's disallowable in future. sorry, it will be allowed in the future. Okay, so that means that this one becomes deductible in the future because you can recover taxes in the future. The same thing applies to impairment losses. The taxman will not, you have put it in your books, but the taxman is not going to put it in his books today. He's only going to put it in his book tomorrow. But you, as an accountant today, you are saying that, yes, I have a tax that I will recover in the future because I know that I will claim this expense in the future. I will book a deferred tax implication on that, and it's a deductible temporary difference. So there's a temporary difference that is deductible. I will deduct this expense in the future. For revaluation surplus, the taxman is saying, yes, it's in your books, but I cannot tax it. When you actually make this money, I will tax it in the future. So that means I'm going to pay tax in the future. There's a taxable temporary difference. So what if you are looking this deep down, if somebody is teaching me this the way I'm teaching you, I will have already understood that what this standard is trying to do is just to ensure that even though the taxman is not capturing what I have in my books, I am capturing it. I am capturing the tax impact. The taxman is not capturing it, but me, I'm capturing it because that is accrual.
will still be deducted later.
Yes, yes. So even though the taxman is saying he's not going to capture provision, but me, he's not going to capture the tax implication of these provisions because he's saying it does not allow me as an accountant. Accounting is prepared on a tax or on an accrual basis. So I need to accrue for the tax. So I just don't want to go there yet. I want you to understand it at a very basic level first. So that deferred tax is like an accrual for tax. That the taxman is not going to capture it now, but me, I'm going to capture it because that's the accounting principle. I have to accrue for all transactions. So I have provisions in my book, then I have to account for the tax impact. So we call that deferred tax. Okay, because I'm not paying that tax now, but I will pay or I will deduct or I will recover in the future. That's why I call it deferred tax. Okay, so to explain it to you, that's why we came from the angle of temporary difference and all of that, because that's what gives rise to this me making accrual for tax. Because if these differences is not arising, if all I have in my account is if the taxman calculates his taxes based on that, then there won't be any differences. But if there are differences, if there is any item that the taxman is not capturing, I have to accrue for the tax. Something like that.
So the provision, I want to just confirm something like provision for bad debts, sir. Have you?
Yeah, something like that.
Okay.
Like provisions for bad debt.
Sir, I have a question, sir. This unused tax losses, can you throw more light on it or give some examples on it?
Oh, yes.
Oh, yes. So,
Mute.
mute.
So, if you have tax losses, okay, the law in Nigeria allows you to carry it forward when you make loss for the year, you know. Instead of having an accessible profit, you have a loss. The law in Nigeria right now allows you to carry it forward. Meaning when you carry that loss forward, if you now make profit in the future, they would allow you to net off that losses from last year. They will deduct it from that your profit. So it helps you in the future. It would save you tax. Okay, so unused tax losses, because you can carry it forward and use it to reduce your profits in the future, it results in recoverability of tax or reduction in taxes So it's an asset to you. That's a deferred tax asset. Okay, so it's like considering the tax impact now today. The same thing for withholding tax credits. So when you have withholding tax credits, you know that you can utilize it to reduce your tax liability. Okay, so that also would have deferred tax impact, or if you have unused capital allowances, right? That's because you can carry them forward and use them in the future. So it results in recoverability of taxes, reduction in tax in the future. So now you accrue for them. That's a deferred tax asset. So that's the angle that is coming from. Okay, I think we should do examples to make it clearer for us. So let's do some examples. I have like 10 examples and some corrections here. Let's just solve whatever we can solve until we are tired, then we'll go home. So Femi, are you there? Yeah, let's go.
Let's look at examples on identifying the tax base of an asset and the determination of deferred tax given a tax rate of 30%. Number one, a machine costs 5,000 naira. For tax purposes, depreciation of 1,500 naira has already been deducted in the current and prior years and prior period. The carrying amount is 2,500 naira. What is the deferred tax?
Okay, thank you very much. So for this one is talking about depreciation and capital allowance. So in the exam, please don't even stress on this one. First, calculate your carrying amounts. And your carrying amount is your cost, which is 5,000, minus your accumulated depreciation. How much your accumulated depreciation? Oh, they have even given us carrying.
1,500.
No. They already gave us carrying amount directly.
Okay, yes.
They gave us
The
carrying
carrying
amount
amount
of
is 5.
25. Yes. So what we need to calculate is the tax base. So the tax base is the cost minus they said for tax purposes, depreciation is 1.5. That means this is capital allowance, Abi. Because that's the depreciation for tax. When you say for tax purposes, depreciation is 1.5. That's capital allowance. So that means the tax base here is how much? 3.5. So in this case now, there's a temporary difference. There's a temporary difference of how much? Of 1.5.
Of 1.5 of
1,000.
So my question to you is that this temporary difference, is it a taxable temporary difference or a deductible temporary difference? Sorry? Uche, I can't hear.
It's taxable.
No, it's deductible.
Tax base is higher than
It's deductible
It's
because
like liability.
it's a liability. Because I told you that if the carrying amount is higher than the tax base, that's a taxable temporary difference. But in this case, is it higher? No, it's actually lower. So it's the reverse.
Okay.
Sorry,
So
I thought the tax
um,
base supposed to be 30% of 3.5.
sorry?
I thought it would be 30% of 3.5.
No. That's not tax base. That's the deferred tax asset. That's when you apply 30% on the temporary difference. But for the tax base is just like you're calculating carrying amount. So for carrying amount now, it will have been cost minus the accumulated depreciation. But these guys gave us the carrying amount straight on. So the tax base is the cost minus the capital allowance, like that, to get your tax base. So you need to be able to interpret this correctly for depreciation and capital allowance. And I've already told you here. So you just need to know this one. Then you can then do the reverse for others. So if the carrying amount is higher than the tax base, that's a taxable temporary difference.
Is
That's a
it possible for the carrying amount to be the same amount to the tax base?
that means there's no temporary difference now.
Mhm.
So in this case now, since there is a deductible temporary difference, that means we will have a deferred tax what? A deferred tax asset by saying 30% multiplied by what? 1,000. And that gives us how much? That gives us 3,000. A bit. That's 300. And that's all for this scenario. So if you know this one, it's always like that in your exam. You will see. Just understand this, you'll find for capital allowance and depreciation. So if the carrying amount were
Yes,
to
sir.
be high, it will have been taxable. Okay, I'm listening with you.
Yes, please. So, assuming we are not giving that carrying amount as 2,000.
Mhm. Mhm. So you will have calculated it. A carrying amount is cost minus accumulated depreciation for this case. That's the same way you do it in IAS 16.
Okay, that
Okay.
means there won't be difference.
But the tax base is
So
still
there'll be
cost
difference.
minus depreciation too.
But you know that the depreciation we will have calculated will have been different from 1.5. So the question say for tax purposes, depreciation of 1.5 has already been deducted. So what this question is referring, this depreciation for him is capital allowance. That means from here now, the depreciation we computed was actually 2.5. That was why the carrying amount was 2.5, which is 5,000 minus 2.5. So in fact, sometimes they will call it tax depreciation. So they might not call it capital allowance like that because this is IFRS. This is not Nigerian tax. It is in Nigeria that we call it capital allowance. In some countries, they don't call it capital allowance. So that's why you will not find it in the standard calling it capital allowance. It's in Nigeria that we call it capital allowance. So that's why they say for tax purposes, depreciation of this. So they are saying that for the taxman, no, what the taxman recognized in place of your depreciation is 1.5. Sure, you get. So what you have recognized for your own accounting depreciation is not 1.5. If it's 1.5, then the carrying amount will not be 2.5. So that means what you recognized was 2.5. And when you do 5,000 minus 2.5, that was how they got this 2.5. Okay, so understand it like that. Semiat, is that clear to you?
Oh. Which means, sorry, sir, which means we have to pay additional tax on that difference of that 1,000.
Happy?
Yeah, but it's supposed to be liability, not asset.
Happy. How now? Explain it further now.
Sir, what me I'm thinking is if you are saying your carrying amount is 2.5, which means your accumulated depreciation is 2.5. Then the tax people now say no, it's 3.5. It means that their own is higher, which means they are going to they are going to charge your tax based on this 3.5, not 2.5. That's what I'm thinking. That since you are charging your own tax, you carry your carry amount is 2.5, which means the tax now is supposed to be on this 2.5. But now, when the tax people now come for review, they don't discover that no, it can't be on 2.5, it's going to be on 3.5.
Yeah, very logical.
I don't know, maybe I'm getting.
Yes, you are.
I don't know, maybe I'm getting it right, sir.
Yes, you are. You're getting it right.
So that's why I'm thinking that it's supposed to be like a liability, not asset. That's why I'm thinking is.
Okay. Is that what you are saying also, Lukman?
Okay. Excuse me, sir.
Yes,
I
sir.
don't know.
The way let me what I understand about this thing is, okay, the carrying amount is supposed to reduce your tax. In my own understanding, it's supposed to reduce your tax. So if you calculate your carrying amount to be 2.5, which means you have shot yourself. So when the tax people calculated theirs, it is 3.5, which means you have like extra 1,000, which is supposed to reduce your tax, and that's why it's not taxable. That's what the way I understood it. But I don't know if that's correct.
So
Okay.
let me add my own. Maybe we can answer everything together.
Okay, all right.
Yeah, in this question now, we are given the carrying amount to be 2.5. In a situation whereby we are not giving the carrying amount, you wanted to calculate accumulated depreciation the other time. Sure,
Yes.
understand? Yes. No, let's now when
It was carrying
deducting the
amount you wanted to calculate.
sorry, you wanted to calculate the carrying amount. Sorry, the other time, but we were actually looking for the accumulated depreciation, whereby we got. But in the question, we are just given the depreciation. Maybe, and if the carrying amount is not in the question, we definitely want to calculate it. You understand? Now we are not giving just depreciation for 1 year. The accumulated depreciation, you can we just assume that the accumulated depreciation now is 2.5 because the carrying amount is 2.5. If we deduct that from the cost of the machine.
Yes.
So I don't know, it's still mixing up. Or is it possible they use another English? Since you said there is no capital allowance in IFRS, would there be a way that you'll be able to recognize that they're actually referring to capital allowance here, not depreciation?
Okay.
I don't
All
know if
right.
you get what I'm trying to say. I don't know.
Yes, I do, of course. So again, and that's for your own dummy is actually very straightforward because they would refer to it as for tax purposes, depreciation is this. So they are referring to capital allowance, or they will tell you that the tax depreciation is this. Okay, and they will say the accounting depreciation is this. So they will make it very clear. And ICAN for your exams would also make it clear because in most cases, ICAN would then refer to it for you as capital allowance. Okay, when I'm solving ICAN past question for you, I can usually refer to it as capital allowance. But I've seen ICAN question referring to that capital allowance as tax depreciation. Okay, so that one is not even a problem at all. Okay, so the major issue we have now is the fact that my people are not agreeing with me regarding this. Why some actually agree. So I think that the agreement I think we should come to, because based on what I've actually taught you so far, Femi is right. If you look at the way I've explained this to you, that the carrying amount is the amount you put in your books, while the tax base is the amount the taxman puts in your book. So, which is good for you, right? So the taxman is giving you 3.5, right? They are giving you more expense, right? Which is how he is looking at it, that it should be like, or Femi, how are you putting, am I saying it the right way? It's not here anymore.
Yeah, I'm listening. I didn't get what you're saying. I'm trying to get what you're trying to say, sir.
Okay, I'm just trying to recap what you said, that based on the way I've explained, that what the accountant put in his book is 2.5, but the taxman is actually putting 3,500, which is giving us more expenses, Abi, which is giving us more
Yes, yes,
deductions.
yes. More, yes, yes.
So how do you think that should result in a taxable difference? So if you want to interpret it from how I've explained, is that not supposed to give you more deductions?
More deduction, as in the money that you pay will be more. That's what I'm saying. You
Ah,
reduce it more before.
okay.
I just explain it. Let me just try to get what you're
Okay.
trying to say first.
Okay. So for this one, for assets or for capital allowance and depreciation, so for carrying amount, this 25, okay, you can see this one as the deductions that we are going to have, that we are going to put in our books in the future. The depreciation, because 25 means that the depreciation will charge in the future. Okay, this 25 means the depreciation we're going to charge in the future. That's what depreciation, that's what carrying amount means. Carrying amount is cost minus depreciation. So it's like the depreciation we have not charged that we will charge in the future. Why tax base here will be the capital allowance we will claim in the future. Okay, for this, if you want to look at it this way, is the capital allowance we will claim in the future that we have not claimed, because it's cost minus what you have claimed, minus 1.5. So that means that from this scenario now, comparing these two, that means we would have an extra claim of 1,000 in the future. We'll have an extra deductions of 1,000 in the future. So if you see it that way, you will never get it wrong. So it's a deductible temporary difference in this case. And this can only help you for capital allowance and depreciation. You will never get it wrong. There are questions that the only thing they will just ask you about is just calculate deferred tax based on this carrying amounts and of asset and tax of asset. So just see carrying amount for asset as the depreciation we will put on our books, we will charge in the future. See tax base as the deductions, the capital allowance that the taxman will give us in the future. So that means the taxman is giving us more deductions by 1,000. So we would have a deductible temporary difference of 1,000. So by the time you apply 30% on that, that's a deferred tax asset. So I don't know if that is a better perspective for you.
Okay, sir. Let me just know if I'm on the right track. So now this 300 we are having, let's say for next year we are to pay 20,000. So we are going to less this 300 from the 20,000 we are supposed to pay for the next year.
Yes.
All right, sir.
Yes.
Okay,
Yes.
sir.
Even though in real life, this is just an accounting whatever. In real life, nobody is giving you back anything. But in accounting, yes, you would deduct it.
Okay, sir. Good evening,
Okay.
sir.
Yeah, Omolola, go ahead.
Yes, sir. So I want to just ask if you can expatiate more on this deductible temporary difference and the taxable temporary difference, because I've gotten more confused with all the explanations since I got it earlier, but with the explanation again, like that's scattered.
Okay. So we're explaining it again. I don't know how that would help you because it's still the same thing. I'm not sure I've said anything different. It's just on this with respect to assets alone, especially depreciation on capital allowance. That's where this one is applying. For the other things I've said, you see when we solve these other questions, those ones will apply. So the explanation still remains like I've mentioned before. Deductible temporary difference, it will result in you having a deduction, a recoverable of tax in the future, a deduction or a recoverability of tax in the future. But the taxable temporary difference, this one will result in you paying more tax in the future. To result in you paying more tax in the future. So still see it that way. Nothing has changed. So the only
Okay,
thing
so
is that, yeah. So for these assets, I just don't want you to, the way they do this, because for assets, we always have to, when we say carrying amount, for asset is always cost minus depreciation. Tax base for asset is cost minus capital allowance. So the interpretation is now tilted with respect to the future now. So seeing this one as the capital allowance, as the depreciation you will deduct in the future, and tax base as the capital allowance you will claim in the future. So because we will be claiming much more than what we have in our books. So you know that for tax purposes, this 3.5 is the deduction we would have. So we would have a deductible temporary difference because we'll be having an additional deduction of 1,000. Additional deduction of 1,000, right? Because in our books, we are saying it's only 2.5 that will be there in the future, but the taxman will give us 3.5. So that means in the future, we are going to be saving 1,000. In the future, we would enjoy an additional deduction of 1,000. So that's only applicable for this scenario here. So we are having a deferred tax asset here and deferred tax asset because is a deductible temporary difference. Okay.
okay,
Any
sir.
other questions?
Let's just get clear now. Thank you for this explanation.
Okay, you're welcome.
Hello, sir.
Yeah, hello.
Sorry, sir. I'm a bit confused. Why are we deducting 30% from the 1,000?
We are not deducting it from the 1,000. That's just our deferred tax assets that we will recognize in the books. It's not,
Okay.
yeah. We are not
Well,
even.
okay, sorry. Why are we charging 30% from the 1,000? That's what I'm trying to say.
Okay, that is how you will always do it. That's deferred tax assets. Deferred tax asset is calculated on deductible temporary difference, and they will give you the tax rate on that.
Okay,
The
okay.
tax rate on that.
Mr. Wasiu, sorry that we are asking so many questions around this simple scenario. It's because it's affecting our tax knowledge on capital allowance.
Okay.
Just like the other lady tried to explain that, okay, if we say our carrying amount, this is what our asset looks like as of today, and the tax base is what the tax authority are saying this is what it looks like. It means we have used our depreciation to reduce the value of assets, but tax people are still saying like still have either more years of more value. Since capital allowance or tax depreciation is an allowance, and now we have used that to reduce our estimates to get our tax and this thing that we did. If we are to charge that 30%, where me I'm still getting confused. That 30% that we are going to use on that 1,000, how we are converting it now to deferred tax assets is where I'm getting confused. Because in tax, we will have seen that as an additional charge. Don't know whether you understand the questions.
I believe if we try more questions, all of this will get clear. So we cannot just tie down here.
Thank you very much. Because now I think maybe
Sorry,
about me.
sir. Can I don't know if I can just explain my understanding in a layman language.
Okay,
Like,
please go ahead.
yes, in a simple language. Okay. The tax base now, that's the machine cost minus the capital allowance. That is what we are expecting to get from the tax authority. And in our own book, we already tried that, we are getting back 2,500.
Okay.
That means we've undercharged ourselves.
Okay.
Thereby, we'll be getting additional 1,000 naira later just to augment the 2,500 that we undercharge ourselves to make it 3,500. So that makes the deductible temporary difference. So that 1,000 will now be a deferred asset to us. And we cannot claim all the deferred assets. We have to use 30%. I mean, use the rate, which is 30% of that 1,000, which should be 300 naira. I don't know if that way.
You want to turn it to discounting factor.
To what?
Yes, now. You just said what I've been explaining since now. So I mean, I don't know what Lukman is now saying, because what I've explained to you is just the way you have explained it now, Dami. You have a deductible temporary. Just the way you have explained it is that's what it is. The taxman is giving us 3,500. Why we will believe we can have 2,500? So we are going to have extra 1,000 as deductions. So since we are having, and deductible temporary difference means that we are going to have a recoverable tax. We are going to have a deductions in our tax in the future. And that is what we call asset. That's an asset. Lukman, that's what we call asset today. So meaning when we say that we are going to enjoy a deduction of 1,000 in the future. So for us, we believe that that's a tax asset. So we will just look for the tax rate. What's the tax rate today? It's 30%. We just apply 30% of that. So it's just saying you have a profit. We are going to make a profit of 1,000. We will not, for tax, the tax on that profit is what we are looking at. What's the tax on that profit? So we are going to have a deduction of 30%. Okay, what's our tax savings? So that's just 30% on that. So it's just 30% of that 1,000. That's why we call it deferred tax asset. If it had been the other way around, where we're going to pay more tax in the future, that is, you're having a taxable temporary difference, then the tax payable on that is 30% on that. That will be a deferred tax asset on that one. So that's it. So if you're interpreting it looking at it in another way around, I don't know. Yeah, unfortunately, your tax lecturer cannot even help you on this. He may not understand it very well himself. Okay, Femi, read the second one, please.
Okay.
Stefan,
The
get an
second one.
assistant now.
Interest receivable has a carrying amount of 1,000 naira. The related interest revenue will be taxed on a cash basis. What is the deferred tax?
Okay, just give me 1 minute. I will give you 1 minute to think about it. Okay, now the question here, this one is not about depreciation and capital allowance. This one is about interest receivable. The question told us that the carrying amount is how much? Is 1,000. And it told us that the related tax will be taxed on a cash basis. So what's the tax base? Who is going to help us with this? You can tell us what's the tax base. So this is the time where everybody can now talk, can now make attempts, just to be sure
Just to
that
be sure that
you follow.
you
Yeah,
follow.
Joy.
Yeah, Joy.
Okay, so this interest receivable, I think, is a provision and tax authority did not recognize it because there's no cash that has been received yet. It's just a provision that was made.
So what's the tax
So what's
base?
the tax base?
The tax base is new.
Okay, so Joy
Okay,
says,
so Joy says,
Joy, you can mute because I don't know, it's echoing. It's okay. Another person, Joy have said 0. Dami, can you try? People that have been talking since, this is not the time to now keep quiet. This is the time to try.
So since there is no other figure for us to compare to know if we have a deferred tax, I think deferred tax does not exist in this question.
Why are you jumping to deferred tax when we are talking about tax base? We said, what's the tax base? You are not going to follow the sequence of my explanation. Why are you scattering everything? Follow the sequence with which I've explained to you. My question is, what is the tax base? Joy said is 0 because the taxman is not recognizing it now. He will recognize it on the cash basis. 0. So you to tell us what is your own cash base based on what I've explained to you. My explanation was very clear.
Good evening, sir.
Yeah, Laura.
And the tax base is 0 because the interest has not, the cashman has not taxed it. It will be taxed in the future.
Okay. Thank you, Laura. Any other trial?
I'll say the interest this is Omomi. I'll say the interest revenue will be the cash base, but until it is received before it can be taxed.
So what's the tax base?
That's this other line here. The related interest revenue will be taxed, which will be the tax base.
So what's the tax base today? How much is the taxman capturing today?
New today. In the
Okay.
future, it will be the amount of interest revenue
Okay,
received.
good. So you guys are correct, actually. So that's what I want. Follow my explanation. Just like those motivational speakers will tell you, follow the money, follow my explanation, and you will never get it right. But by the time you are following a route that I did not even explain, you will scatter everything. So that's perfectly correct. The 3 people that have spoken, you guys are on point, and it's in line with what I've explained to you. You in your books, you have 1,000, but the taxman says, no, I cannot tax this today because you have not received it. The taxman says, I will tax it on a cash basis. So that means the taxman will capture 0. Okay, so in your book, you have 1,000. The taxman captures 0. So there's a temporary difference. There's a temporary difference of there's a difference of 1,000. Now, the major work is this a taxable temporary difference or a deductible temporary difference? That's another question.
The taxable temporary difference.
Perfect. Taxable temporary difference. And it's very clear. The taxman is saying that, see, I'm not going to tax it now. I'm going to tax it in the future. It's clear. So that means we'll have a taxable temporary difference. And taxable temporary difference will always result in deferred tax liabilities. Now, Lukman will now come and say, how did this one convert to deferred tax liability? The way it converts is that all taxable temporary difference means that you are going to pay tax in the future. There is a payable in the future, right? So the tax impact of that is 30% of 1,000 and is a liability. So when you say payable, when you say taxable, that's a liability. So we have a deferred tax liability of 300 naira. And that's what you're going to do. Okay, well done, guys. So at least you guys are able to solve this yourself. Let's see if you can get the other one right. So is there anyone that is not getting this? Please, if you're not going to come up with a different interpretation from what I've taught you. So if you are not getting it right from what I've taught you, not from something else. And Femi, you have to participate, not just be reading question.
I'm participating now.
Okay. Read this next one and answer it.
Jesus Christ. Trade receivable have a carrying amount of 2,000 naira. The related revenue has already been included in tax profits as tax loss. What is the deferred tax?
Okay, so from here now, the carrying amount is how much? It's 2,000, Abi?
Yes, sir.
How much is the taxman going to include?
Well, just like this one too is trade receivable, which means you have not received that money, and then but you have to include it in your book. So the taxman now will not tax you at present because you have not still received that money. So it's still going to be zero. And it's going
Okay.
to be carried forward.
Okay, so Femi is saying the tax base here is 0. Any other trial? Any other trial? Who can come from another angle?
Good evening, sir.
Yeah, hi, Ore.
Yeah, the tax base is 0 because the trade receivable has already been taxed.
Okay, when did they tax it? Probably in previous period or whatever. But you guys are actually right, but maybe luck or something like that. But the reality is that your analysis is correct in both parties, but Ore was actually spot on because we're told that the related revenue has already been included in taxable profits. So which means that the taxman has already included this item based on what they are actually telling us. They have included it. So as far as this year is concerned, is not here. They are not including it this year. They have included it in previous year. So for this year is actually zero. As far as this year is concerned, the tax base is zero. But alternatively, this is not, because which is why I was asking, when was this included? Because the question didn't tell me when they included it. If they are telling me that this amount was included in this year, okay, if it's included this year, so that means the taxman includes 2,000 this year, Abi? So, and the way it is now, if I interpret this as they included it last year or whenever, it's not so clear. So the best way for you so that you won't make any mistake, the best way to interpret this is based on the way they have given you. They said the related revenue has already been included in taxable profits. So I would just admit that the taxman agrees that he is going to include it this year. Abi, the taxman is, because they said the related revenue has been included. That's the way, that's whatever it is. They are saying is going to include it. So, which is what I will recommend. That means the taxman is also putting it in his books. That means the tax base is 2,000 also, and not zero. If I want to follow this interpretation from this question. So it's different from this one when they say that he will include it on a cash basis, meaning he is not including it. But here they are saying he has already included it. Okay, the related revenue has already been included in taxable profits. So that means the taxman is putting it in his own book as well. So the taxman is capturing 2,000. In this case, the temporary difference is zero. In this case, the temporary difference is zero. And that means when temporary difference is zero, that means the deferred tax implication is also zero. No deferred tax implication here.
So how do we interpret the loss, the tax loss from the question?
You don't need to interpret it. So what is important is that the taxman has included it, whether in taxable profit or tax loss. So they just say it's like or tax loss. What is important is he has included it.
It won't
So
have any effect on the tax base, like.
no, it doesn't. It has no effect. So what is important for us right now is that the taxman has included this 2,000 also. So our focus is the 2,000, not the loss or the profits. But the taxman has included it. That's the focus. He has included it. So the tax base is 2,000. Yeah, Priscilla.
Okay, since you said it has been included already in the previous tax year, why are
No,
you
it's
still
not
doing?
in the previous tax year. Oh. There's
Okay,
I was
okay,
just
okay.
that's just an assumption
No.
which is wrong.
Mm,
So I immediately changed my because
okay,
we could interpret it that way, but it would be wrong because it's not clear. The question didn't
okay,
say it in the previous year. If it's
okay.
if the question says in the previous year, the tax base will be zero.
That's why I'm trying to know.
It
Why
will
are
be
we
zero.
still having a tax base? Okay.
If the examiner have told us that in the previous year, it will be zero.
Yeah.
So here now he means in this current year. That's how we have to interpret it because they didn't tell us.
Okay.
And we are talking about this year. So the tax base is 2,000.
Okay. Okay.
So let's go to question 4.
Dividends receivable from a subsidiary have a carrying amount of 5,000 naira. The dividends are not taxable. What is the deferred tax?
Okay, let me take the simple one, the carrying amount. The carrying amount is 5,000. What was the tax base?
Zero.
Zero.
Zero. So is this a temporary difference? So there's a difference of 5,000. Is this a temporary difference?
So this one is saying the dividends are not
Sir,
taxable.
I want to say something. No, if they say
So it's not
okay,
okay.
can I?
Continue, ma.
Okay, can I continue? Okay,
Yes,
what I
ma'am.
wanted to say. Okay, sir. So it said, okay, so I'm waiting for you to take that box away. So it said dividend receivable from a subsidiary have a carrying amount of 5,000. Dividends are not taxable. What is the deferred tax? So I feel the tax base should be 5,000. So at the end of the day, you'll be having a deferred tax of 0. You're having a temporary difference of 0. So since they said it's not taxable, because if we say it's 0, then we'll be having 5,000 as difference, and then we want to take deferred tax of 30% on it, which will be taxable. I don't know if I'm
Okay.
right anyway. It's just
I won't say you are wrong, but if I want to follow what I've taught you today, since they told us that the deferred tax are not taxable, it means that the taxman is not going to capture it.
Oh.
Yes. So if I say tax base is 5,000, that means I'm going against what I've taught you. So they say dividends are not taxable. It means the taxman will not capture it at all. Therefore, it is a permanent difference.
okay.
And
I
permanent
understand.
difference does not have deferred tax implication. I think I explained
Okay.
that to you.
Yes. Yes.
So that's how you should look at it. So no deferred tax impact.
All right, sir. Thanks, sir.
Yes. Okay, let's go to number 5. Femi.
A loan receivable has a carrying amount of 2,500 naira. The repayment of the loan will have no tax consequences. What's the tax? What's the deferred tax?
Okay, let me do the simple one. The carrying amount. Carrying amount is how much?
1,500.
What's the tax base?
0. No, no, no.
0.
0.
Yeah, 0.
Is this a temporary difference?
That's permanent.
It's a permanent difference.
Yeah,
tax consequences.
this is a permanent difference. 0.25. Let me read this next one. So it has no deferred tax impacts.
Okay, sir. Let's look at few examples on how to determine the tax base and calculate and the calculation of deferred tax. Number 1, current liabilities include accrued expenses with a carrying amount of 3,000 naira. The related expense will be deducted for tax purposes on a cash basis. What's the deferred tax?
Okay, let me do the simple one. The carrying amount is 3,000. So what was the tax base? What was the tax base?
Supposed to be 3,000.
What was the tax base?
Size 0.
Thank you, Joy.
Thank you, Joy.
It's zero. This one is now, I think we have mentioned this one already. So that means the taxman will not capture it this year. He will capture it when you collect the money. Right? So when you pay the money. So it's a temporary difference of 3,000. Now, is this a deductible temporary difference or permanent temporary difference? Sorry, or a taxable temporary difference?
The taxable temporary difference.
Taxable.
Is what?
Taxable.
Okay. Why is it taxable?
Because we will still pay it in the future.
You still pay what
You
in the
still pay what in the
What are you
what
paying?
are you paying?
When the cash is received, the tax authority will recognize it in the future.
Okay. You can mute, so I won't be echoing. So it's not taxable, it's deductible because they said the related expense will be deducted. They didn't say it will be taxed. So it will be taxed because this is an expense. You have an accrued expense. The taxman is saying, no, this expense, I'm not going to allow it as a deduction because you have not paid it. He's saying when you pay it in cash in the future, then I will allow it as a deduction. So it's very clear. They said the related expense will be deducted for tax purposes on a cash basis. So they will deduct it in the future for you. So it's a deductible temporary difference. That's how it is in the question. I'm not inventing anything. They said the related expense will be deducted for tax purposes, meaning that that's when they will allow the item for tax, right? So, meaning in the future, you will have a deductions. You will have a deduction. So that's a deductible temporary difference. And when you have deductible temporary difference, it will result in a deferred tax assets. So when you do 30% of that, gives you 900. Yeah, let's tackle the next one.
Current liabilities include interest revenue received in advance with a carrying amount of 5,000 naira. The related interest revenue was taxed on the cash basis. What's the deferred tax?
Okay. So the carrying amount is how much? It's 5,000.
5,000.
What's the tax base?
0.
Why zero?
Why zero?
The tax base is still
5,000.
5,000.
5,000. 5,000.
5,000.
Because it was
Why
taxed.
5,000? Why 5,000?
Size 0.
So it's 5,000 because it said that current liabilities include interest revenue received in advance. That means the cash has been received. And here it stated that interest revenue was taxed on cash basis. So we already have the cash.
What's the tax base?
For me, it's 5,000 because it has
To me,
been
it's 0.
taxed already.
But the question is, when was it taxed? When was it taxed? When you it's clear when you collected the money. So did you collect the money this year? If you collected the money this year and they are taxing it this year, then that means, yeah, you are correct. It's 5,000. So, but if you collected the money earlier, then that means you're wrong. That means they taxed it in the previous period. So that means it will be zero now because they are not going to capture it this year. So that's how we should look at it. So which one are you going for?
Zero.
You are going for zero, mommy. Why are you going for zero?
Yes, sir. Okay, because current liabilities include interest revenue received in advance with carrying amount, and this carrying amount is like a difference between the revenue, interest revenue, and will I say the depreciation or something. But this revenue has been received before and it has been taxed. So since this is the current year, is zero.
Okay, yeah, that's on point. I think I agree with you. Is there any other suggestion? Let's see if anyone can change our mind. So for now, based on our explanation, it makes sense. So those that are saying it should be 5,000. So can you come up with your reasons why it should be 5,000? If I want to go along with what we have discussed before, then these current liabilities received in advance. So when they say received in advance, which means that you did not receive it this year. You have received it in earlier years, not this year. When they say anything, current liabilities, that you received an interest in advance, meaning you have received the interest. You have already received it maybe last year or thereabout. That's why this year you're having it's a liability. That's not even the case. The point here is that you have received the interest, and the taxman have taxed it when you received it. Right? So I agree with Omomi fully that this tax base is zero because the taxman is not going to include it again this year. Is now zero now. It's now zero. So if there's no, those that say 5,000, if you cannot come up with your justification, then the tax base is zero because it was taxed on a cash basis, which means that the taxman is not going to include it this year. He has included it in the previous year. So there will be a taxable temporary difference of 5,000 because now is zero. We have a temporary difference of how much? Of how much? Of 5,000. So is this a taxable temporary difference or a deductible temporary difference? So it cannot be a taxable temporary difference because it's not like you are going to be having, we are not paying any additional tax anymore. We have already paid the tax we are supposed to pay. So that one is gone. We are not paying any tax. What's happening right now is the reverse of that. So what can happen is it then becomes automatically deductible, temporary difference, since it has already been taxed. So then now you can then deduct it when you finally do the work and you're recognizing it. But since it's not taxable, it automatically becomes deductible temporary difference. Then for this, we are going to recognize a deferred tax asset. We're going to recognize a deferred tax asset at 30%. We're going to recognize a deferred tax asset at 30%. I'll give me one class. I will join very soon. Yeah. at 30%, and that is 30% times
1,500.
1,500. Okay, I will stop. I have to stop the class now. I will just allow you guys to try this on your own. You can just try these three. Then on Saturday, we'll just solve all these questions. We'll just solve all these questions together. I have a lot of questions, and there are many questions. I can ask these things very well, which is why I'm taking my time to explain this to you. If you understand all of these scenarios, your exam is easier than this. So when we start solving past questions, you will see the exam is not so difficult if you can do all of these things yourself. And if you follow that my explanation, it's a lifesaver. If you go to another route, it will just scatter everything for you. You would not just take it as simple as what are we putting in our books? That's 5,000. That's the carrying amount. What's the taxman putting in his books? That's the tax base. If from the scenario, they will tell you whether we're going to pay more tax in the future or whether we are going to enjoy a deduction in the future or whether it won't have any tax consequence. If you are going to pay more tax in the future, then that temporary difference is a taxable temporary difference. If you are going to have a deduction in the future, it's a deductible temporary difference. If there won't be any tax consequence, it's a permanent difference. That is it. That is all. That is all. So just try your best. Revise this. Look at these working notes again for the ones we have looked at or we have solved together. Then you would be fine. So it's already 9:30 and you guys have been very patient. So you have been very engaging today. Let's continue like this and we'll be fine. So next week, we're going to finish up IAS 12 and also IAS 37 on provisions. So provision is a very short standard. So we're going to finish it up. So somebody said I did not share yesterday's notes. I actually shared it, and Femi even made a comment on it that that I did not share the complete notes, which I shared immediately. So please check it and read it. That shows that you have not actually read it. That's not good enough. Okay. Do we have any questions? I will see you on Saturday. Bye for now.
Thank you, sir.
Thank you, sir.